Hi, very good evening to all of you. Wish you and your family members a very happy Deepavali and a very prosperous new year. May the new Samvat 2080 fulfill all your dreams and ensure that you make your clients rich by investing in Kotak Mutual Fund. Let's look at how the economy and markets are poised for this year. If we look at global economy, where because of inflation fear, central bankers raised interest rates to multi-year high. This resulted in inflation coming down globally now from high single digit and double digit. Inflation has moved to lower single digit. As inflation starts coming under control, some central banks like US Fed and European central banks have started keeping pause on interest rate policy. The rates they have raised, they are waiting to see how that impact will be felt in the economy. To some extent, central bankers are able to pause because recession probability in many parts of the world has started coming down. Central bankers have done great balancing between growth and inflation. They have raised interest rates, but inflation has, they have raised interest rates, brought inflation down, but ensured that recession is averted. Are there some concerns? Yes. In countries like Germany, the recession has been averted probably, but income expectations have come down dramatically. And this could cause a problem for growth in the days to come. The other challenge which central bankers are facing is that as interest rate rose, their investment in fixed income securities deteriorated, and many of them are now loss making. US Fed will make more than $100 billion loss. Swiss National Bank posted in just one quarter $12 billion loss. So central bankers have become all red thanks to rising interest rates. Some central bankers have become adventurous to cut interest rates. And after a long cycle of raising interest rates, we have started seeing some incidences where central banks are cutting interest rates led by Chinese central bank. This is the slide from previous presentation. The markets are indicating very, very confusing signal. Stocks are falling as if there is a recession. Oil prices have risen as if there is no recession. Gold is falling as if inflation has gone. Interest rates are rising as if there is 10% inflation. Commercial real estate is falling as if there is a subprime crisis. And housing prices are rising as if interest rates have come down. This conundrum was true more in last month's presentation, but we have retained it. Who knows what will happen next month? Coming to US economy, the US markets are as confusing as global market. For the first time in US history, for 3 consecutive years, interest rates have given negative return. This has never ever happened in US history before. In fact, United States of America's 10-year yield today gives more yield than an emerging market nation like Vietnam. This is all possible because Fed maintained a very, very delicate balancing. On one side, they raised interest rates at fastest pace to control inflation. On other side, they didn't take out liquidity as quickly as needed to control inflation. This delicate balancing ensured that American inflation came down, and yet growth didn't become negative or country didn't go into recession. The US quarter three GDP grew at the fastest pace in 2 years. A lot of it is attributable to fiscal deficit. When the year started, fiscal deficit estimates were $1 trillion. Now it is $2 trillion. As government kept on spending money which it didn't have, it resulted into GDP growth. As GDP grew, unemployment remained at a very, very low level. This is one of the few periods in American history where labor market has remained tight despite so much rise in interest rates. Are there red signals in American economy? Yes. The national debt is now $33.7 trillion. In the month of October alone, America added almost $500 billion of debt. The speed at which America is raising debt is creating concern for the American economy. In 1980, America's debt to GDP ratio was 35%. Today, it is 125. It is up 90% in just about half a decade. There is no hope for debt reduction in the near term. American fiscal deficit is likely to remain high as a percentage of GDP for the foreseeable future. As deficit remains high, the government will have to issue more paper, and there is huge supply of government bonds coming in American market. While on one side supply is increasing, as it is shown in the right hand side of the chart, the left hand side chart shows that demand for US Treasury is actually coming down. We are seeing that central bankers of the world who are buying US Treasury are not looking to buy Treasury as much as before. Next slide, please. American yields have risen, and part of that rise in yield is function of large supply coming from the American market. One thing we have to remember, interest rate goes up in steps like an escalator, but it can come down in an elevator in one swift movement. Fed will not like to raise interest rates by 3% at one shot, but if need be, they can cut interest rates very, very quickly. Fed continues to face challenges. Their biggest worry, after having brought down inflation from high single digit to low single digit, can they relax? Will it result into something like 1966, 1983, where after initial drop, inflation bounced back thanks to the Gulf oil crisis, and that created a lot of embarrassment for Fed. The second will be burden of debt on American economy. The bankruptcy filings are highest since 2020 COVID shock. Fed will be closely monitoring is higher interest rate pushing more people, more firm into insolvency. The Fed's task is complicated by the fact that personal savings rates have started dropping, and today savings rate is almost equivalent to what it was in 2000. Without savings, people will not spend enough money, and growth, which is slowing down, could tilt towards recession. Some of the news coming out of US are scary. CVS, which is a large retail chain in US, instead of putting real item, they are putting photographs on the shelf because they are worried about crime. This shows that in America there is uneven recovery, where rich have become more richer, but poor are probably not benefiting as much. The number of people who are on strike is today almost as high as they were in the 80s. 80s was a turbulent period. Now, same turbulence is being witnessed in American industrial sector. Number of Americans who need two full-time jobs to survive have increased by one-third from 2008. It shows or it reconfirms again K-shaped recovery. As a matter of fact, now earnings yield are favoring fixed income as 6 months treasury bill gives more return than S&P 500 current earnings yield. Equity market in US have done well, but well, that's attributable entirely to Magnificent Seven stocks. Facebook, Apple, Amazon, Google, Microsoft, Tesla, and Nvidia. These are the seven stocks which have pulled the market up this year. Rest of the market, 493 other stocks, have remained more or less flat. If we compare Indian economy, well, we continue to remain oasis in the desert. IMF believes we'll become third largest economy in 2027. British Institute believes we will achieve that in 2032. Trade deficit has narrowed down as exports have grown at a faster pace than imports. Direct tax collections continue to remain robust. Inflation seems to be cooling off, and industrial production seems to be picking up. There are some worries on the horizon. Geopolitical situation in Middle East can impact availability of oil as well as prices of rural recovery thanks to uneven distribution of monsoon could get impacted. IT sector is not hiring, in fact, it is retrenching. And most political parties are announcing freebies, which will have disastrous impact on fiscal prudence. Within those risk factors, our growth continues to remain good. We will be contributing substantial percentage to global economic growth in the days to come. Capacity utilization is now above long-term average, and activity level globally activity level across India has continued to move up. The current power demand is higher than summer season. It shows activity level picking up during festival season. Industrial production growth at 10% plus has gone into double digit after almost a year and a half. GST collection 1.5 trillion is the new normal. Last collection came at 1.72 trillion, which is the second highest in GST's collection history. Indian companies on it have deleveraged significantly, and now they are spending money to set up capacities. They are spending money to build capacities. The central and state government ahead of election are full throttle on infrastructure investment, and the combined spending of central and state put together will be higher than roughly about 15 trillion rupee. Large part of investment is led by governments and private sector. PSUs have been little bit on the back foot in terms of stepping up on investment. Large part of this investment is driven between services and industry. Hopefully, we should be able to reach our pre-pandemic investment level in the days to come. Housing has bottomed out and started moving up. It reached a new high in terms of sales in second quarter FY24. Consumer sentiment after taking a hit in COVID have now started rising. The only worry was unexpected rise in unemployment number from about 7% in unemployment number. Last year CMI data suggested that unemployment has jumped up unexpectedly to 10%. We'll have to see whether it's a blip or whether it's a trend. One of the reasons for increase in unemployment could be IT sector hiring, which has slowed down. In the first half of FY24, about 51,000 jobs were lost within IT industry. Normally, they should have added about 1.5 lakh to 2 lakh jobs. Instead, they reduced jobs by 50,000. Oil prices have risen by about 22% in the last 5 months, but it looks like America's relaxation of sanctions on Venezuela is keeping oil prices under check. Good for us if oil remains below $80 a barrel. One of the reasons why we can't take lower oil prices for granted is that oil companies are not investing enough for the discovery. The new operating oil rigs have actually kept on going down for last about 6 months. The biggest news for India is relaxation of sanctions on Venezuela. Venezuela has more oil reserves than Saudi. Their production is just about 750,000 barrels, almost 1/10 of what Saudi is producing. If sanctions are relaxed, Venezuela can pump more oil, and that could tilt balance of oil from demand towards supply and can bring energy prices further down. The real challenge for India is freebies. Every political party is announcing freebies to win election. I just hope and pray they will repackage existing subsidies to ensure that we don't deviate from the path of fiscal prudence. Today, it gives me a lot of comfort to say that India has done well and other countries have done badly, which is why we look even better and brighter than what we are. One of the factors which is driving India towards sensible growth is its fiscal prudence. We continue to remain one of the lowest debt among major economies. If we come to the market, second quarter FY24 results for large cap companies have come in line or ahead of expectation. 12 companies out of 36 companies delivered more profit than expected. 19 companies delivered as per expectation, and 5 companies delivered little below expectations. Overall, earnings growth have come in a reasonable expectation. If we look at the profitability, after bottoming out in FY20, it has now increased to touch above 4% level. With this kind of profitability growth, obviously fundamentals are continuing to run higher and catching up with the prices. If we look at Nifty EPS estimates for FY 2025, on a conservative basis, they have remained around 1078. We believe we should be able to get a number somewhere around 1100 to 1125. We have seen in the past that profit growth and market cap growth is almost linked. Between FY20 to FY23, Nifty earnings grew at about 22% and markets grew at about 27%. If FY24-25 can see 20% plus earnings growth, we hopefully should see 20% plus growth in market cap. If we look at valuation of the market, large caps are trading at about 4% discount to its historical average. Mid caps are trading at about 6% premium to historical average. And small caps are trading at about 21% premium to its historical average. Large cap, mid cap is an amber signal, and small cap probably is a red signal. Our market cap to GDP ratio continues to remain above 100% and above historical average of 80%. Thanks to domestic participants, thanks to great work done by all of you, the 1-year rolling beta of India has come down relative to emerging markets. That means our risk premium should come down. Investors should be comfortable putting more money into Indian market. There has been a lot of FPI selling in last 2 months. It's probably driven by the fact that emerging market funds have faced redemption, which is one of the highest since 2022. And as global funds faced redemptions, they have gone and taken out money from Indian market. FPIs were seller in the month of September and October. They have been sellers across emerging markets in the month of September and October. On a relative basis, from a valuation point of view, emerging market today trade very, very attractive to US market. One good thing about India, it gives easy exit. When FPI sold 2,55,000 crore worth of equity between October 21 and June 22, markets gave them all the money back with an impact of just about 10%. But in India, entry is difficult. They have bought just 1,45,000 crore worth of equity and markets are already up 21%. FPIs will remember this lesson. इंडिया में निकलना इजी है लेकिन घुसना मुश्किल है. The future of the market will be driven by events. When does Fed start cutting rates? What happens to election 2024 results? Will oil go and touch triple digit? Will rural consumption recover? If all these events are positive, markets will continue to rise forward. If all or some of these events are negative, there might be suitable discounting to that extent. At this point of time, we believe it's time to have equal weight to equities with marginal overweight to large cap, equal weight to mid cap, and marginal underweight to small cap. If you look at how earnings yield spread is between mid, small, and micro cap compared to large cap, the following slide shows that gaps have narrowed down significantly. Other way to look at The combined weight of small and mid cap in 2003 was roughly about 9.5 plus 7.2, about 16%. Today, the same has doubled almost to 32%. This is very, very comparable to small and mid cap weight in indices when correction started somewhere in 2018. Clearly, the percentage of stocks which are in small and mid cap as a percentage of total market cap does create some pressure, does create some anxiety for long-term investor. If you look at equity market, SIP or STP with a long-term view will be the right way to go ahead. Many of our funds have delivered fantastic return over a period of time, and their rolling return for SIP over a long period of time has generated positive alpha. If we look at on a point-to-point basis, across most time periods, we have generated alpha. It's in equity fund as well as in hybrid fund. And even in SIP, across most of the funds, we have generated value add. Next slide, please. One of the complaints was about flexi cap fund not doing well some time back. Now it is back with full bang, and across time periods it has started delivering outperformance over benchmark index despite its 40,000 crore size. Multi-cap fund continues to prudently allocate between large cap, mid cap, and small cap, and it has generated an alpha of about 5%. Kotak Equity Opportunities, a large and mid cap managed by Harsha, continues to deliver fantastic alpha over a long period of time. We are in the process of launching our Kotak Healthcare Fund. This is the new sectoral NFO launched by us. If we see healthcare sector, you have domestic pharma companies, you have export-oriented pharma companies, you have research-oriented pharma companies, you have companies which are focused upon specialized drugs. We have companies which are manufacturing APIs and bulk drugs under PLI. There is also hospital chain, also diagnostic chain, and also finally the makers of medical equipments. Put all these things together, healthcare provides a very diversified opportunity. Indian healthcare industry is one of the best in the world. It is third highest in pharma production by volume. It serves 200 plus countries. It provides 60% of global vaccine. It provides. If we look at Indian pharma industry, it's comparable to Indian IT industry 20 years back. IT industry started on Y2K. Then when the gate opened, they started providing application management, infrastructure services. Eventually, they started doing value add by consulting and using digital ecosystem. This resulted into a lot of value creation for IT industry. Same thing is happening in healthcare industry. The initial healthcare wave started with low-cost medicine, but now we are giving branded medicine also. We are also into specialty chemicals. Indian doctors are large service providers in US and UK and some other markets. Put together, healthcare is at the same stage where IT was there about 20 years back. The demand for healthcare services will continue to grow. All of us have become armchair investors rather than having a very active or physical life. The junk foods we are eating as if nobody's business. This kind of unhealthy lifestyle is likely to result into higher demand for medicines. If we look at our NFOs, out of last 8 NFOs launched over last couple of years, the only NFO where experience has been unsatisfactory is Kotak Global Innovation Fund of Fund. This fund we raised from you to invest with Wellington, but that experience hasn't worked out well. Other than that, all the funds which we have launched in recent times have done better. Coming to the debt market outlook, US inflation has started cooling off, but for Fed, it remains above their threshold of 2%. As mentioned before, Fed made a pause on interest rate. This policy, as indicated or as discounted by the market, probably Fed doesn't want to rock the boat. US 10-year yield marched ahead to touch 5%, almost similar level as 30-year treasury, and then declined as the weak data started coming off. Is US interest rates near peak? Well, it looks like the Fed's announcements and press meetings indicate that US rates probably have started peaking out. In Indian market, liquidity had become negative. It was thanks to the government tax outflows. Hopefully, in the month of November and December, liquidity should turn positive. As liquidity got tighter, overnight rate started trading towards upper cap of the RBI policy rate. CPI inflation has continued to drop, and now it is at around 3-month level. RBI does indicate that geopolitical uncertainties could keep interest rates high. For RBI, it is better to be safe than sorry. RBI also talked about open market operation and that pushed the yield higher. But I think RBI will exercise the decision of launching OMOs in a prudent, calibrated manner. For Indian fixed income market, 7 to 14-year segment continues to look more attractive. The 10-year yield, again, like equity, will be function of how event shapes up. But we believe in second half of 2024, interest rate cut could begin this cycle. If we look at the best way to perform India's fixed income market, dynamic bond fund continues to provide value to customers. The Kachua Khargos fund, the hybrid funds, they continue to give higher upside and lower downside, ranging from 2 to 4 times upside downside ratio. If you look at our equity allocation, in debt hybrid, we are at around 25%. Equity savings, net equity is about 29%. Kotak multi-asset allocator fund of fund dynamic is about 58%. And balance advantage fund is roughly at 49% over last 3 years. The debt hybrid fund has a balance of equity and debt, and it could be good substitute for someone who wants better return than fixed deposit at slightly higher volatility. For higher tax bracket person, Kotak equity saving scheme, Kotak equity scheme is perfect for investors. It has about net equity allocation between 10 to 50%. arbitrage between 15 to 80%, and fixed income between 10 to 35%. With average equity allocation of around 40% plus, this fund has delivered fantastic outperformance and lower volatility over the years. Coming to gold, well, in 3 out of last 4 years, gold has delivered positive return well above fixed income yields. Globally, some profit booking is happening in gold as we are witnessing gold ETFs redemptions in US. However, we believe gold is poised for higher cycle thanks to the central bank buying. Gold prices do get supported when US interest rates come down. Today, US is giving 5 to 5.25% on policy rates. This will eventually get cut, and that should be supportive for gold prices in 2024.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.